Thanks a lot, David. It's a pleasure to be here, and thanks for everybody for participating during the holiday season in this seminar. And as David said, I would like to present a paper I've written with Harold James and Jean-Pierre Landau on the digitalization of money, and also allude to another paper on the equivalence between public and private money, which is with Dirk Nippold. And it's a pleasure to be in this forum, the Crypto Blockchain Economics Research Forum. It's a new experience, and I'm very glad to be here. And thanks again for inviting me. So what I want to talk about, and that's probably nothing special for this audience here, you're all studying that. And with the introduction of new forms of money in the digital age, many old questions resurface, traditional questions. What is money? And how should we think about money? What are the different forms of money? And now, of course, with the emergence of M-Pesa, we have Alipay, WeChat Pay, Libra, and so forth. Digital money seems to be everywhere. And with COVID, it's even the case that cash, physical cash, is going away in many countries, even faster than before. Any trend typically is speeded up. And of course, we had so far digital money already. So we had typically digital money in your bank account, you have your credit card and all this. That's all digital money as well. But what we have now is a different form of digital money, typically digital currencies, which is outside money. And I come to this distinction between inside money and outside money in a minute. But essentially, it means it comes from outside the system. It's in positive net supply, while inside money is in negative net supply. So meaning that inside money, when you issue inside money, it's a liability of somebody else. So if you have a deposit with the bank, it's a liability of the bank. If you, on the other hand, hold cash, it is not a liability for the central bank. You cannot go to the central bank and say, okay, I would like to have something in exchange for it. You can have for the $20 bill, you can have two $10 bills, but you cannot have any real things against it. But with all this digital age evolvement, now we have different question come up. So will private digital money drive out cash? And that drives many central banks. They're worried about that cash is becoming less and less important. And cash and outside money, that's provided by the central bank. So if most of the money is provided by private firms in form of digital money, like you see this beggar here in China, he's, instead of asking for cash, he's asking you to hold the smartphone against this QR code and transfer something in his Alipay account. Then the central banks get increasingly worried about losing the grip on monetary policy. Okay, and we will talk about what does it mean to lose the grip on monetary policy, or put it differently, more starkly, will Facebook down the road run monetary policy, not only for the US, but for the world? And what does it mean? And central banks are very concerned about that. And I will allude to that, how to think about these things. And that essentially also means that the governments will not get the seigniorage benefits. And I will go into seigniorage issues. So the government gets a lot of seigniorage benefits every year. Will this go to Facebook or other private banks? And who should get the seigniorage after all? Then I will talk about digital dollarization. That's essentially there's different currency competition going on, and it will be the case potentially that Libra or other digital currencies might take over as a currency and drive out the dollar. The term dollarization typically refers to a setting where in Costa Rica, for example, or many other countries, they have a hard time to establish their own national currency because people use dollars, and that's where the term dollarization comes from. But digital dollarization means that some digital form, private companies' currency might take over, for example, Libra and others. And then there's some issue, we coined this term, this digital currency areas. You can think of different ways about currency areas. There's optimal currency areas. But once you're in the digital space, what is an optimal currency area? How to think about a digital currency area? And all of this, the question then is CBDC the answer. So central bank digital currency, if cash, which is typically the ultimate final money anchor, if this is going away in the form of some digital, perhaps private money, so central banks offer their own digital money. And then there are different forms of central bank digital currencies. You can have that everybody has a reserve account with the central bank, with the Fed, or you can have some wholesale central bank digital currencies, and we will talk about this. So this paper is more conceptualizing things. There's not so much math in it, so there's no formal model, but it thinks about various aspects and tries to conceptualize it, going back historically what we thought about money, but also in the context of the digital world we live in. So let me give you the roadmap. So I want to point out 4 elements in particular. The first one is, what is the technological trends? How does this change the industrial organization of finance? And I will argue it will inverse, leads to radical shifts in the industrial organization of finance. Then I will talk about new currency competition. How do different currencies compete? And then I will talk about the international monetary system in a world with digital currency areas and digital dollarization. And finally, I will talk about monetary sovereignty, meaning can a country still conduct monetary policy and manage the business cycle? Essentially, what does it take for a country to be able to manage the business cycle? And that goes at the intersection between public and private money. And I will talk about that. So that's, on the one hand, monetary sovereignty means you can get the seigniorage, but it also means, can you manage the macroeconomy? Can you stimulate the economy by cutting the interest rate? Or can you not stimulate anymore because people are not using the dollar anymore, they use some other currency, and then the Fed is essentially without power, without sovereignty to manage the macroeconomy. So the first thing I would like to highlight is, if there are any questions now, we can already inject.
We don't have any yet in the Q&A, so
okay.
Let's proceed.
So feel free to ask questions in the Q&A. I'm happy to take questions anytime, and I will break occasionally for the questions. So let me first talk about the technological trends. As a digital platforms ecosystem, so we change and now much more to a digital lifestyle, or the virtual world becomes more and more prominent. And you can see that the COVID crisis is actually making this way, way more prominent already. I'm not coming to a live seminar. We meet and talk and chat in a live environment where you're physically together. Now we're already in a digital world. And all this also means that there are a lot of data generated. So with this webinar, probably you generate a lot of data, who is attending, who is asking for question and so forth. And the big question is, of course, who controls this data? Who will have this data? And the same thing is, of course, all the case once you start all the payment. If you pay in cash, nobody can, follow up who the data has because there's a lot of privacy involved. Once you pay everything in digital forms, the data is with them. And the first point I would like to make is that there's an inversion of the industrial organization of the financial activities. And what I call here, while payment was in the olden world was always a stepchild. It was never a center point. So the main activity was, in the bank-centric world, was lending, deposit taking, and then there was payment as well. But payment was not the core issue. Okay, so you have different customers and you're connected via a bank. You do some deposit taking, you do some lending, and payments are part of it. But payments was, compared to lending and deposit taking, was not the key thing. And even in research, it is the case, or payment is often considered as not the most hot item concerning on. Now we move to a different world where the whole world becomes more payment-centric. The first thing is we might move away from a bank perspective more to a platform perspective. So banking is part of the platform, but there are also asset management and other elements. And the payments are very, very at the center. So whenever you buy something, you see the payment. So there's a lot of data flowing through the payment system. So there's a lot of valuable data, especially the big change is, of course, you can now connect this data with machine learning algorithms and other things. So there's way more better ways to explore and exploit data compared to earlier, with a lot of new methods we didn't have before. Of course, we had some credit scoring and other things in the bank-centric world, but now we can, depending whether you buy an orange tie or a blue tie, we can figure out, what is your default probability or what is some other thing. So there's way more you can put in. And you might see already that, that Amazon or Alibaba and others might have a much better idea what your category, what the default probability is, compared to a single bank, which doesn't observe all of these things a platform is observing. And hence, the value of data is, of course, combining various data sets across many aspects, from e-commerce and payments and social networks. And that's why all these firms, Alibaba and many other things, Facebook and so forth, they're putting some emphasis on becoming part of the payment system. And the whole thing becomes much more payment system. And for the bank, it's a big shift, because their information, they're now not at the center of the world anymore. They're outside. So the payment platform is the center, what's going on, where you get most of the information. That's what the value is. And now the question, of course, is, will we move to this payment platform? And it depends very much on the regulatory environment. So if the regulators decide, we move to some payment platform, there will be at the centers, then it will for surely come. Of course, the regulatory environment can prevent that to keep the banks more at the center. And you can see in China already, it's very much a payment platform. Whenever you want a loan, you go to Alibaba or Ant Financial, and then you ask, can I have a loan? And then Ant Financial is auctioned off among the banks. But the bank, is just one out of 17 banks is bidding essentially to give you a loan. But the information, the credit scoring, and all this is done by Ant Financial / Alibaba rather than by a bank. And so the whole power shifts. And that's a radical shift, what we're observing here. And that's also has implications how to design monetary instruments. And the question then is, does the platform want to have its own money as well? Why should it stick with the official money? And that's essentially the next step going from there. So what are the digital trends? So the digital trends you have, as I mentioned, that is digital platforms or ecosystems. So it's a whole ecosystem which is digital, or what I call this digital lifestyle in the paper. And you have this data advantage, you have this inversion of the industrial organization and the financial activities. Of course, the other important component is the smartphone. Because of the smartphone, we can actually immediately pay with, so in the olden days, you had to take out a laptop. That was not very feasible. And with the smartphone, you see it in particular also with M-Pesa in Africa, and that the smartphone made a huge difference. Another big difference is that the world is way faster than it was before. So payments occur in real time. That has some implications. To some extent, it is stability enhancing, because of this delay cost always, some problems as well. But it also means if there's a crisis, and there is actually a much faster crisis. So it's not the case anymore that you can wait till the weekend and push it to the weekend and then figure something out over the weekend with the central bank. Things will occur much faster. Of course, netting will occur also much faster, which is, as I said earlier, stability enhancing. So you don't have this 2 days delay. And the central banks, they're really trying to keep up with this with gross net settlement, real-time gross settlement. They're also trying to adjust to this speedier world, otherwise they know they will be sidelined. Now, there are other aspects as well. So there's this Internet of Things. So there will be a lot of payments in the future from machine to machine. There might not be even a human being involved. That's also where digital payment is very critical. And then I'm sure you've learned a lot from David and others about the smart contracts and value chains, contingent payments to minimize credit risk. So there will be a lot of payments automatically executed based on their various contingencies, particularly across the global value chains or other value chains. And that's something going on. And then on top of it, we have tokens instead of account-based money, forms of money, and this distributed ledger technology. All of these technological trends impacts the money aspects. So and that's where I want that's my starting point. So we have a radical change what's going on in the financial sector, but all of them also have a huge implications on the forms of money. And the way the new forms of money will crystallize, and that's what we propose in this model, or that's what we hypothesize, I would say, is by new forms of currency competition. And perhaps it's another natural point to see whether somebody had a question.
Yeah, Markus, we have 2 questions in the chat, and I wanted to add a third one of my own. Do you see the chat, or would you like me to read them out? Or I'm sorry, in the Q&A.
It's probably, let me see whether I can open it. Yeah, I can see it.
Okay,
Should
so
I
why don't
read
you?
it? Oh,
Yeah, please
you
take
read it for
those
the
2.
others? Okay.
Yeah.
Can we or should we design digital payment systems that do not create data as an externality to our platform? From Rainer Böhme. So that's a difficult issue, and I think that's I would say the data has a lot of value too. That's a very deep question, and the question is, how do we protect privacy on the one hand? On the other hand, we would like not to throw information away if this information is value enhancing and is also serving certain customers better. So you can have, you know, what's very important, I didn't put this on the slides, but in the paper, it's recommender system. If you have a platform which can provide you a much, much better recommender system, then why would you throw all of this information away? The customer is benefiting from that. So in general, I would say we should not design platforms where the information is thrown away, but we need to find, and that's a huge research agenda on its own, we have to find some ways to protect the privacy of individual data such that it's not exploited. And I have some work on, you know, insurance companies, inverse selection problems, we call it, with Rohit Lamba, where you say, okay, how do we make sure that the platforms cannot extract all the consumer surplus? So far, you get a lot of information rent, essentially speaking in economic language, by not revealing all the information, you as a customer get a lot of information rent. And the information rent essentially is going away from individuals to the platforms. And there is, of course, value creation if the platform can serve you better, but it should, you know, also be the case that the information rent is fairly shared. It's not only transformed to the platform and the consumer surpluses are going away. So I would say a qualified no in this question. Then Jigua asked, Markus, if you think it is too early, please postpone. I would like to see your perspective on what kind of technology really changes the way we think about financial economics, while what kind of them is just reducing transaction costs. So perhaps I will, when I go through the talk, I will come back to these questions, but I think most of them really change. I think you cannot just argue it's a reduction in transaction costs, because it depends how broadly you define transaction costs, but it's really new data and a combination of data and recommender systems and monetary transactions. All of this combined, I think, makes a big difference. So I think having just a model where the transaction costs are reduced would not capture this, especially there's an interesting dynamics going on within this data. So I think there's a whole field of data economics which comes into play and interacts with the money aspects here. But as I go through, I will probably highlight what you can capture with transaction costs alone and what you can't when we go through it. Then Will Kong, should I include this question as well? So a few slides back, we had a figure showing how payment platforms are taking the place of banks. Is that mostly consumer oriented? I have the impression that for bigger institutions at this stage, they may not be interacting with payment platforms as much, but are more connected with traditional banks because they have multiple connections with banks and traditional financial institutions. With consumer, payment platforms acquired them through e-commerce mostly. Yeah, so I was very much consumer focused, but I think it's also for bigger banks, and there might be many, many platforms also considering supply chain and so forth. So I think it's probably both, but for consumers, it's probably most prevalent because the data generation is most pronounced. In general, I'm not an expert in particular, you know, where will the biggest breakthrough come from? It's a little bit looking too much into the future. But I would say the consumer side, we have seen a lot, in particular in China. So China is ahead of us in this regard. And we saw already, you know, we can learn from the Chinese experience in this regard. And perhaps if I just touch upon China a little bit, you see already that a huge pushback against Ant Financial and WeChat Pay, against the private companies taking too much power, knowing too much about the customers, and the PBOC, or the People's Bank of China, really is trying to get their own digital currency in place. So that's a big change there. And the other banks lobbying very hard to the People's Bank of China to introduce their own digital currency in order to reduce the influence of financial / Alibaba and WeChat Pay. There's more and more questions coming in. So how do we do it?
I think certainly take the next one because it is directly related to what you just said.
So can you consider, oops, sorry, now it jumped.
You still see it?
I got it, yes.
Yeah.
We can consider, so Arash Alosh asked, can we consider new platforms like Ant Financial and so on, a new type of bank? If so, aren't they still in the center financial system? Yes, so it's very closely related. I think the big difference is, of course, banks have a lot of information too. I don't think they had the same ability to exploit this information, but the big difference, I would say, is that you combine it with a lot of other activities. So a bank was never, looking in your Twitter account saying, what did you tweet, and use some machine learning algorithm to exploit, what your attitudes are to certain aspects, and combine it with your purchase behavior on Taobao or on Amazon and so forth. So this combination across not only the financial decisions, but also on the social media, and combining it with other purchasing behavior, online purchasing behavior, that's, I think, the new element. And on top of it, I think what's the most important is this new technology of having the machine learning and all the other new aspects coming into place, combining this. I think that's what we describe in the paper. That's essentially the biggest thing.
Let's push Jason's question to the end because he's encouraged that, and it's a broader question. I wanted to ask a quick follow-up about Ant Financial and WeChat Pay. When they process payments, are they creating money in the way that a fractional reserve bank would create money in our economy? And I've had big disagreements with Chinese students about this who say that they don't play a money creation role, whereas I think they do. And I think your paper also supports that point of view.
Yeah, so to the extent they only make, when they grant you some loan and say, oh, here is then the great money. So they are also in the money creation business, but the payment itself is not a money creation activity. So I think they do both. So on the payment side, if I just make a transfer from me to you, on my WeChat Pay or my Alipay, I don't create money. I make, of course, increase the velocity and that. But what they also do, I can also get as an SME, I can get a loan through them. I mean, it's of course connected to a bank, and the bank is ultimately creating the money because the bank is granting the loan. Ultimately, they're just a middleman, but they're facilitating this, and by facilitating, it's much easier to get more loans, and this way they're creating money as well. So I think both perspectives are correct to some extent. Just depends which angle one looks at.
Okay, thank you. So let's return to your presentation now.
Okay, so I think it was very good to have these questions. That's essentially the technological trends. And what we see is as a big change, I would say, the platform focus and the better combination of many, many data and doing machine learning, exploiting the data in a much broader sense. Now, let's move closer to the currency aspects. And what we push in the paper essentially is this new currency competition angle. And in particular, what the argument in the paper is that we have an unbundling and a rebundling, okay? So unbundling, what I mean, so money has essentially three roles. It's a unit of account. So it's like a temperature, Fahrenheit or Celsius. It's a unit of account. So how do we count things? It's a store of value and a medium of exchange. And the argument we make in the paper is that typically when we have money is serving all three roles simultaneously. But this doesn't need to be that it's all served by the same form of money. It could be that we have one unit of account and the store of value is some something else, and a medium of exchange is a third currency. Okay, so it doesn't need to be the case that the same currency is doing all three roles. Of course, it's natural to have it combined, but you can see there might be some money which is very good as store of value, but it's not really a good medium of exchange because very few people accept it. So in the past, it was quite difficult to say, okay, I don't use the dollar, but then I later on need the dollar because it's a very good medium of exchange, and then I have to swap it. And because there are always bid-ask spread or huge transactions cost to switch from one currency to another currency. But once I get the transaction costs down, and that's where Siguar's point comes in, between switching between currencies very easily, I can actually say, okay, I go to the store of value and I hold my wealth there. And just a millisecond before I need it, I switch it to this other currency, which is a very good medium of exchange. And we use essentially this medium of exchange currency as the currency then to make the transactions. And as soon as the other person gets the transactions, he switches back to another store of value. So it's not natural, so natural anymore. Once the transaction costs between switching across different currencies are very minimal, that all of these three roles are combined in the same currency. Okay, so that's the first one. That's the unbundling. So the bundling then occurs. What we argue, you have much more bundling with particular platforms. But let me stick with the unbundling of the three roles. And having different currencies is traditionally we have this before. So we had this Gresham's law. In the olden days, we had gold and silver currencies often running parallel. So for big items, you paid in gold, and for small items, you paid in silver, and so forth. And typically, Gresham's law essentially said that, the lower value of the currency has a higher medium of exchange. So the velocity is higher. So you want to get rid of this less valued currency, and it gets a higher velocity, and the value of this currency derives from this higher velocity. So it's a better medium of exchange. So it might not be a good store of value to get a lower interest rate on it or lower return on it, but you're willing to hold it because you can easily transact with it much more easily because most people accept it, while the better store of value, which gives you higher expected return, you cannot transact, and that's an equilibrium outcome, and that's what this Gresham's law essentially tries to describe if you put in a modern context. And I try to make this, and this decline in switching costs, so this exchange from one currency to another currency, reduces actually network externalities. Okay, so currently, if others use the dollar, it's very hard for you to come with the euro or something else and say, I would like to pay with euros. It's very unusual in the US to say, okay, now I want to pay with euros. You have some switching costs. You have to go over to the bank, exchange, get a bad exchange rate, and so forth. So you also use in dollars. And one analogy I like is, and that comes back to Ottmar Issing. He said, oh, currency is like a coordination. We coordinate on a certain asset. It's like a language. Certain sounds we coordinate on, and then we can read and understand that. And like having low network externalities means very easy to convert in another currency. It's like a speech translation software. So languages will be much less homogeneous, that we have all speak English in the US. Might be much less common once we have all, Skype and other software technology, which translates immediately, Google Translate in any second. So we will not learn so many languages anymore, but it also would mean we might have more languages, and different languages specialized in different things, and machines will just translate it. There's just an analogy here. So the forces to coordinate on a particular currency or on a particular language are going down, and there will be this unbundling going on. Now that's the unbundling component, and there will be more currency competition also in the sense of Hayek, where Hayek essentially said in '76, at the war, when we had very high inflation rates, there should be more currency competition, but because of this bundling, you don't really have good currency competition. So remember, when you want to limit competition, you bundle products together, and then it makes competition much harder. And typically the European Commission or some antitrust authorities, that try to unbundle things in order to have more fierce competition. And that means unbundling leads essentially to more fierce competition, but then role by role. So each role can have some more fierce competition. Now the rebundling is that you rebundle a currency with a certain platform or some ecosystem, okay? And that's what we mean is that you might have a particular currency for a particular platform, and you get some discounts on this digital ecosystem if you use this particular currencies. And if these are private currencies, each private currency has an incentive to offer discounts if you use your own platform. So, and that's also how Alipay got very popular in China. You know, if you pay with Alipay, you get some 1% or something, a discount, and the store owner might also get a discount. And that's, you know, how you say, okay, if you live in the Alibaba or Alipay platform, and then you get some discount. Or if you have certain smart contracts, you can bundle now currency with certain smart contracts. So it's a different form of bundling. It's not the 3 rolls of money. It's now bundling it with some digital features. And there will be a lot of new forms of money coming up with product differentiation. So there will be private currencies which focus on particular aspects. So this currency, for example, is much more privacy focused. So it protects your privacy. And this currency then, I call it a privacy currency. Perhaps Apple is doing this. They focus very much on privacy these days. And so it protects your privacy. Nobody will get your data, whatever you buy, but you get a low interest rate on it because it protects your privacy, or you have to pay a higher transaction cost or whatever it is. And then the question is, will this be a closed ecosystem? Each of these private currencies, how easily can you swap from one to the other one? That might be in the control of the private platform, which offers this particular currency. And that also depends very much what the regulator is saying about interoperability. You know, how easily can you make an interoperability design across different currencies? And that's where the regulators step in. But in general, you can see already that the currency areas we had, where you have the US dollar, the euro, the renminbi, Japanese yen, and so forth, which is very much based on national boundaries, is going away from national boundaries. It's going much more into digital platform space. And each digital platform might have its own digital currency area, and there's exchange rate across these different digital platforms. And that's what we coined essentially digital currency area. So that's what we specify in this paper. We said, okay, we call this digital currency area, and that's what got most of the attention out of this paper, this digital currency area aspect. Now, perhaps it's a good time to interject some questions.
Yes, we have 2 in the chat, and I think now Jason's question deals directly with the unit of account, so it's good to take it now. Okay. There are 2 other colleagues with their hands up, and I will suggest that they type their questions into the Q&A, and okay. If you keep your hand up, I will defer you until 12 o'clock when we have the open Q&A.
Okay.
So please go ahead.
What changes to digital currency bring to our current asset pricing model frameworks, if any? Given that in traditional models, the numeraire is typically arbitrarily specified, if there are changes, what would be the best framework to capture? Yes, so I don't think there are immediate implications because we don't really have money in our asset pricing frameworks in it. I mean, it's most of our asset pricing is almost done in a real sense. So, but it probably would make sense to enrich asset pricing, given that most of our asset pricing movements these days is driven by the central banks. So whatever the central bank is doing, buying assets to QE and other things. And that drives stock prices and other asset prices around a lot. So it might make sense to bring more monetary elements into our asset pricing frameworks, and then it would make a difference. So as we have our asset pricing framework at the moment, there's no, we don't have to change it radically, but I think it's also missing a big component, and that's when we bring money in, and then the issues like convenience yield and transaction roll of money. And I will actually come to a formula in a minute where we say, okay, let's bring it in, and that's a particular way of bringing it in. It's a very generic way of bringing it into asset pricing, and you will see, Jason Lee will see it right away where it shows up. And then I think we can talk about this. Perhaps you can raise it again at the end in the Q&A. So Rainer Böhme would like to know, on unbundling, which roles of money do you think CBDC could serve well, and which roles are better left to the private sector? I think for me, what's very important is to preserve the monetary authority or sovereignty with the central bank, because the central bank is non a profit-oriented entity and has to manage the macroeconomy. So you have to stimulate the economy when you go in a recession, or if inflation goes up, you have to cool it down. And private companies, if they take on important currencies, they don't have the same incentives. So, and I will come to this in particular, and that's where the CBDC would come in as well, whereas, okay, because of CBDC, we don't have to switch to digital, other private digital money. We can keep it as an official money, and that it will be the anchor. So if you do a bank run, let's suppose, ultimately you can convert it into some official currency rather than a private currency. And that's, I think, where the importance of CBDC comes in. So it is like replacing cash. So we see cash going out, and then the question is, will it be replaced by some private currency, or will it be replaced by some other digital public currency? And that's, I think, where it's very important to have some public anchor to it in order to preserve the monetary sovereignty of a country, and meaning be able to allow the country to conduct its monetary policy and to manage the business cycle. Then Max Raskin asked, when writing about the roles of money, Hayek in 1976 is against the view of money as a state creation. Creation of language is done without a state. How do you think the interplay between unbundling and very regulated system of finance? That's a deep question, so that's hard to answer in a minute. So Hayek was very skeptical. So he thought, competition among the currencies is the healthiest thing, and that was during a time when we suffered from very high inflation, and he thought that would be a way to keep inflation in check, because low currency will actually lose out. And we have this, when we talk later about dollarization or digital dollarization, it will be much harder for some, less developed country to go for high inflation, because then the citizens can just switch over to some digital currency, Libra or whatever other currency. And given this force from outside, the central bank or the local ruler can actually not say, okay, I just print money to fund something and do some government funding with that. So that there's some force there, and this Hayekian force, I think, is very useful, and it is there, and it should be there. And with digital money, it will be enhanced, because the switchover will be much easier. In terms of language, I agree with you that language is not highly regulated. The network externalities, of course, are also different. It depends on the country a little bit. If you go to France, language is highly regulated. In other countries, it is not. I haven't thought so much about regulating how the regulation of language can be translated into regulation of money. I think the big difference, in my view, the biggest difference is that you have the ability to manage the business cycle with monetary economics and monetary policy. You don't have this in the language space. I think that's a big difference. There's a market failure in a sense that you need to manage the business cycle. And I think most economists would agree with that. We don't have this cyclical behavior of languages, or any way to, if we couldn't control the language, we can actually fix some other problem. I don't think that's the case. And Larry Wall is asking, your primary focus seems to be on the finance and privacy aspects of this. However, given the antitrust concerns about the big tech firms in the current environments, do you think the antitrust authorities would tolerate the creation of ecosystems that use private money as a way of further restricting competition? Yes, so I agree with you, though. So there are two concerns. One is to lose the monetary sovereignty. That's more the concern of the central banks. And then there's, of course, the whole antitrust component to it as well, which is the concern of the antitrust authorities. And both have different concerns, but they are connected to each other. And so how this will play out and how they will cooperate on this, and which there might be a turf war between the two, and how it will play out in the international arena, that's still open in the air. But I think at this stage, we have to figure out what's a good way to regulate the anti-competitive arrangement. So we don't have a good way to deal with the digital world yet. So that's another, I mean, if I were a PhD student, I would zoom in on that. It's an open question. There are many, many things to be thought about. What's the best way to regulate these big tech firms? Just looking at, is the consumer getting a lower price or not, if everything is for free, is not really the way to look at. In my view, it's a barter arrangement where you essentially give away your privacy, you give away some consumer surplus or many, many other products in exchange of getting some digital services. And how we deal with that, that's still open. And I think there has to be some aspect of it. Okay, I'll take one more, David, or Coach John asked the question.
Yeah, go ahead. The questions are piling up, and I'll let you strike the balance between your prepared slides and the questions.
But a little bit. Oops. Okay. In addition to control over monetary policy, there could also lose control over other policy imperatives, such as redlining and lending. Yes, there are a lot of issues also in terms of the lending policy. I agree with that. You can also who is included, who is excluded from certain platforms. That's a big component. Who has the power? So money is power. So giving access to money is power. If you have cash, you cannot exclude anybody. If it's digital money, you can exclude things, or you can decide as a private bank not to give a bank account to somebody. All of these issues will come up and have to debate it, and we need a regulatory framework for that. I guess we can learn. We have already learned a lot from bank accounts and financial inclusion and these aspects. We can incorporate some of these aspects, but there's definitely new perspectives to it, in particular if you can be excluded in many other dimensions as well. And of course, as I mentioned before, the whole price discrimination aspect comes into play. And once it's a machine learning algorithm, you don't know whether you will be discriminated or not. It's because even the company doesn't fully understand why a machine learning algorithm has decided that this person has to pay a higher interest rate than the other person. So let me take two more questions, and then the two open questions, at least, as I can see, from Jakob Leschner. How is digital payments different from old electronic payments methods such as Visa and wires? So in a sense, it's not, so it's different and it's not different. Let me just highlight the differences. The differences is that it's a new currency, and I will come to this. So Visa and wires is not a new currency, it's just anchored on the dollar or whatever the national currency is. If you think of Libra or Bitcoin or others, it is a totally new currency. So there's an exchange rate, and there's somebody conducting the monetary policy, or there's an automatic rule for that. And that's one big difference between the two. And I would say the other big difference is just the combination with these platforms and combining all these different ways of exploiting the data, machine learning and so forth, as I mentioned before, and the recommender system. That's, I think, these are the two big differences. And Rainer Böhme would like to know on digital currency areas, if we lose the connection to countries on which aggregates will be collect national account statistics, etc., carry out macroeconomic research and make policy. Yeah, so the paper makes a strong prediction at the end, and I will come to that, which is a little bit overblown, but essentially what we argue, the digital currency areas will not be the physical borders of a country, but what matters a lot is what is privacy regulation. Okay, so which areas will determine the privacy regulation? That's what we say at the end of the paper. And then you get back to national boundaries to some extent. So you will have privacy regulation at the Euro area or European Union area. That will be essentially one digital currency area. So it's much more the European Union area, or you can see now the fight between US and China. It is what about the digital privacy regulation? That's what we said, a year ago when we wrote this paper. And that will determine all the digital currency areas. And to some extent, you get back to the national borders, but it can be bigger areas depending, how you control the the privacy regulation, and that will be the big battle, and that will also determine in the digital currency areas which areas together have some privacy sharing. And there might be certain countries which share the privacy and exchange the views and have common standards. And some people argue we might split now the world into two parts in a bipolar world, which a digital Cold War, where we have these two internets essentially, and that means you have, to some extent, two digital currency areas, two main digital currencies, and then there will be smaller ones underneath based on platform to platform. And let me pick one more and then I go on, because otherwise my 60 minutes are over. So Jakob would like to know, doesn't Visa have a lot of data now? Yes, I talked to the Visa guys, and they're complaining that they don't really see much, because they only get, you bought in this liquor store, you bought something for, $15 or whatever, because John probably buys more expensive wine, but $30. You bought something, you can infer it's a wine bottle, but you don't really know exactly what you bought. So the information content you have on these other digital platforms, in particular, if you also have the Amazon or the Taobao connection, you get a much deeper understanding what people are doing. So that's one thing. The other thing is, I've heard that, of course, Visa and MasterCard, they're not technologically as advanced as some of these platforms are in providing a recommender system. They never build a business model around that. And that's why they're not at the same stage at this stage. And the other thing is, they are justified that because they don't see the same depth of data compared to what the big platforms are seeing. Okay.
So Markus, I think we better suspend the questions now and save them for afternoon. Yes.
So I will speed up a little bit, but can I take extra 5 minutes or something, because we covered some questions?
Absolutely.
Okay. So let me talk about the international monetary system. We talked about digital currency areas already. So the question is, what is really a currency? So we thought a lot about this paper. What is really a currency? And the way we define it is the same unit of account. So it's very obvious, if you have dollars or euros or libras, and Libra is actually changed now. Libra is now based, there will be a dollar Libra, euro Libra, and so forth. But when we wrote this paper, what was essentially just proposed, one Libra, and then it was a different unit of account. And then convertibility. And so what is convertibility? Convertibility means that you want to link it to something where you can easily convert it. So if you have a deposit in a private bank, you can convert it to a dollar bill. You have the right to convert it to a dollar bill subject to a bank run. And the important aspects to this is it maintains the values. It's always as valuable as a dollar bill. And it also gives the uniformity of money, or some people call this the singleness of money. That's one uniform. There's no asymmetric information about this. There's no information and sensitivity about it. So you have this. If you have a deposit, as long as the bank is sound, it has the same value. You don't have to double check and worry about Lemon's problems and all this, going back to Bengt Holmström and others, Gary Gordon's research. So the convertibility guarantees that. Now there is, of course, a difference to convertibility. The second weaker form of commitment, not convertibility, is this backing. And the different types you can back a currency. You can say, okay, I form a currency board. I have the Hong Kong dollar, for example, but it's backed with some US dollars. And we say, oh, there you can swap one for the other. But subject to that, we changed our minds. Okay. So it's not less strong than convertibility because you can change your mind. So currency board is, weaker, and I would say it's not the same currency. So Hong Kong dollar is not the same as a US dollar. It's a separate currency. And this sense, although many stable coins like Ether and so forth are not, they're separate currency because, they can change their minds. There can be a different rule, there can be different changes. So that's a separate currency. So that's, you see already, it's a little bit gray, and we had to think a lot, think about the real world. When is something a real new currency? When is it still part of a currency? And that required some conceptualizing, which we outline in the paper. And as I mentioned before, of course, there's account-based and token-based approach, and cash is very stark. Essentially, cash is a token. I pass on the cash to you. The payment is finalized, and nobody has to verify anything. No third party has to verify it. And so there's a transfer. Was if you pay a checking account, the bank has to, agree that actually this transaction occurs, and there might be some money laundering laws or whatever activities which might stop it and so forth. With cash, it's token based. You pass on the token, it's done. And with digital money, it's always a little bit in between because nothing is 100% token based. But the key, I think, is the way we define it, whether a third party has to agree, and it's of course account based, or has to verify in a particular way. It has to verify the account owner. And with cash, you don't have to verify anything. The finality of the payment is very, very strong with cash. And that's when you have a token-based system, it's the finality you have as well going on. Now, having this in mind, so then you say, what is a currency? So you talked about already what is then a currency area. And a currency area where you have your own unit of account, and so it's your own currency essentially, and you have a payment instrument inside this currency area. And in the olden days, or in the current days, we have the Eurozone, it's a currency area. We have the US, is a currency area. China, Japan, and so forth, that's a currency area. But as I mentioned before, it's not geographic necessarily anymore. It's how well you combine it with a digital platform. So as I mentioned before, price discounts, the price discovery, transparency within a platform, but not outside of the platform, that defines in the future a currency area. And that is tightly connected to digital dollarization, where you say, okay, what country is easily overrun by some other currency? And I told you all some smaller Latin American countries, also in Europe, some smaller European countries. Most of the people, instead of using the local currency, they might use the euro or the US dollar. And that's why it's called dollarization. So the dollar essentially is playing the role of the currency. And of course, when the Fed sets interest rate policy, they don't set it based what Costa Rica needs. I just mentioned Costa Rica because I have a co-author on my inverse selection paper. He's working at the Central Bank of Costa Rica. So the Costa Rican Central Bank is very alert of this dollarization. And that will happen in a different form that, let's say that the renminbi, the digital form of renminbi is, influencing certain neighboring countries dramatically by offering a digital renminbi, and it might take on an important role in the economic activities in the neighboring country next to China, and the neighboring country has very limited control over their own monetary policy anymore. And if you look at the three roles of money, what's really the key role to maintain is the unit of account. Okay, the store of value is not so important, or the medium of exchange is not so important. What's really important, you maintain the unit of account role. And this loss, and there's some Zhang and Velasco have some recent paper in terms of normal dollarization, not digital dollarization, but you can translate that. This is a highly nonlinear system. So it's, for a long time, it looks like for many Latin American countries, a big issue. You have control over monetary policy, and then you go beyond a certain limit, and suddenly you have lost the control over your monetary policy. And that's a big deal, because from then onwards, you cannot manage the macroeconomy with monetary policy anymore. And of course, there's always the question, what is it? Of course, the medium of account and the medium of exchange, the invoicing, is and what invoicing is occurring. And the other component is what currency is your debt denominated. So once your debt gets denominated in dollars, things change dramatically in terms of monetary policy. And the third aspect I would like to mention briefly is we might, with the digital monetary system, we might go to a digital synthetic world currency where we have, one symmetric supply of safe asset, and it's much more, symmetrically supplied rather than primarily by the US, or to some extent by Japan and Germany. And I've worked on this a lot with also with Nick Huang, my student of mine. We worked a lot on how to supply symmetrically a safe asset. And I can just refer to this additional paper for that. And this, so far, the big problem, I think, for the international monetary system is that whenever there is a crisis anywhere in the world, there's flight to safety, and the flight to safety goes into a safe asset, goes into dollar, and this has huge exchange rate movements and makes it very expensive to manage the crisis for emerging economies, because suddenly the funding costs go up dramatically because the interest rate goes up, and there's huge capital flows out of the emerging economies into the US or Germany or Japan. Makes it easier for the finance minister in Germany or in Japan to manage the crisis, but very difficult for the emerging economies. And that's a world currency would actually help to do this. We don't need a world currency, we just need a world safe asset. And I've proposed something for the Eurozone, which then called SPs, which then are proposed for the whole world as CLOSPs. That's a way to do it. And within a digital system can be even more easily done. Now, let me just rush now through this monetary sovereignty, which I explained already, and a little bit, but I want to go a little bit more formalism here. So the public versus private money, historically, so we're very familiar that money is a national thing, but it's a fairly recent phenomenon. My co-author here is Harold James, and he's a historian. For him, centuries is not much. No, it's just for the last 200 years we have this national money. And you know, coming back to the three roles of money, what's interesting is that it doesn't need to be the case that the store of money has to be tax-backed. So you can have a lot of money. For example, as Saddam Hussein was kicked out of power, the Iraqi dinar was still in northern Iraq, was still used as currency, even though there was no government anymore backing it. You couldn't pay any taxes for that. And it was, you know, it was just a medium of exchange. It was a good high medium of exchange for all. Similarly, in Somalia, the Somali shilling, even though the central bank was not functioning, there was no central bank anymore because the country fell in disarray, but the currency is still thing. So the focus that it has to be tax-backed is one reason, but it's not necessarily the case. It's also the case if you use it as medium of exchange focus, it still works. And as I mentioned before, the unit of account is really the key. If you have a very New Keynesian perspective, then it's more the stickiness. You know, is it sticky in what type of, the prices are sticky in what? In the public money, in dollars, or is sticky in Libra? You know? What stickiness do you have? Or what is the invoice income? So Gita Gopinath has worked a lot on that, and others. Actually, my third chapter of my PhD thesis was on that many years ago. But if you are focused on financial friction, that's what I'm focusing more. It's more how is your debt denominated, and it's like the intertemporal numeraire. So, and that gives you the power of monetary policy, because as you change inflation, you shift wealth from borrowers to lenders and vice versa, and that's what you do ex post. But ex ante, we can anticipate which way it goes, and then you can shift wealth around. So for example, if you have big shocks like the Brexit shock for the UK, will the Brexit be a hard or soft Brexit? We don't know. But if it's a hard Brexit, we let inflation run out or beyond the target a little bit. That shifts wealth around and it may cushion the Brexit and give some risk sharing. If it's a soft Brexit, we don't do it. So you can see ex ante, this is a risk sharing mechanism. And monetary policy can be seen as this risk-sharing mechanism. In this sense, there's a close, tight connection to finance, because monetary policy is all about risk-sharing, and that's what financial assets try to do. If you have complete markets, monetary policy has no bite, but with an incomplete market setting, this has a big bite. Now, the current arrangement between public and private money is a two-tier system. So we have, you know, they have the governments. The governments provide the outside money, the unit of account, and the settlement among these reserves or outside money. And the private banks then provide inside money to the population. Okay, that's a fractional reserve banking. In the future, I would say it's the government and the banks, but we also have the big tech companies here. So this is not a blockchain trilemma thing. That's a different triangle. And there are different ways to do this. So the People's Bank of China prefer very much a narrow banking model. So they really want to cut back on the big tech companies. And some years back, they say, okay, as we came back to the Alipay cannot create money because everything has to be backed what they do, and they imposed a narrow banking model. Okay, that's very much enforced by the People's Bank of China. They're very insistent on that. India, I mean, so the Bank of International Settlements is very much going for the India stack model. Where essentially the idea is that if you think of railroads, the tracks, they're actually provided by the public sector, but then the trains can be private. Okay, so it's a combination of the two. So the backbone is actually set by the public sector, and then there will be a lot of competition, interoperability enforced at the private sector, and that's the India stack. And the former chairman of Infosys was very involved in that, and that's also what many people in the regulatory community see as the model to go forward. Let me jump over that. Let me go to the monetary sovereignty. So one is the seigniorage. I mentioned this already. The control of monetary policy. We talked about this a lot. So if Facebook managing the monetary macroeconomy, there's an intratemporal, intertemporal perspective to it. I think the more interesting is the intertemporal, and that's essentially referring to the Brexit example I was referring to earlier. You redistribute ex post, and ex ante you provide insurance. You stabilize balance sheets. So the idea is that you let inflation, essentially debt will be inflated away, so you stabilize some impaired balance sheets in certain sectors. Can be the banking sector, can be other sectors. And when you introduce CBDC, so you might say, oh, I have to introduce central bank digital currency to keep control of my monetary policy. And the big critique is always it might crowd out funding for the banks, who then actually fund real capital investment. And that's why we have fractional reserve banking. CBDC is choking off credit funding. And then another critique essentially, CBDC makes actually bank runs more likely because you can run into CBDC very easily. You have a silent bank run. You run out of the bank, just transfer money into some CBDC account you have with the central bank. So bank runs are much more likely than before. The whole stability is less so. And let me just highlight that. So that's where the other paper comes in, and I know I was too ambitious in getting things done, but that's for Jason's question. So what in asset pricing? So typically what we do is you maximize some utility, some consumption and leisure, and then some assets. There's the price of the asset J, and then you get some payoffs of this asset J from the previous holdings. So the asset holdings A here, then you consume some certain goods, so you have to pay some tax and so forth. So that's a standard utility maximization problem. That's what we typically do in asset pricing. I think what we have to add to it is more a liquidity constraint, and then there's a Lagrange multiplier on top of it. So this liquidity constraint can be a cash in advance constraint, can be a money utility function. So if you put this Lagrange constraint, solve for the axis, and put it, then you can put it in, then it's just money utility function. You have another element, so that's another way. There's some shopping time models or the new monetarist models. All of them can be mapped in this generic way of doing things. So that's what we did in this paper with Dirk Knippold. So this is like a very general framework where you can really map all existing monetary models into this. The current asset pricing framework is not taking this into account because there's no money. And then there's a no Ponzi game condition on top of it. But that's for infinite horizon models. But that's the element I think we should incorporate in asset pricing much more as well in order to have the money components in it. And you can view this as a generic liquidity constraint based on the asset holdings, and you have a Lagrange multiplier on it. Now, if you solve the asset pricing model, then you will get the standard asset pricing model is essentially the price of asset J is just the stochastic discount factor, and ignore this term for now. It's just the payoff plus tomorrow's price. Okay, and that's what we typically do in asset pricing. But with this liquidity constraint, I have this additional term here, which is 1 over 1 minus lambda. That's my Lagrange multiplier, and that's a derivative of my Lagrangian with respect to asset holding J. So I have this additional term here. Okay, and this is 1 minus, so there's another multiplier here, and I call this multiplier capital lambda from t to t plus 1. Okay, and then I can iterate it, and then I get this asset pricing equation. It's the same asset pricing equation we always work with, except that there's capital lambda here, and that's now multi-period capital lambda. It's the product of many of these one-period capital lambdas. But that's, I think, would be a more modern way of doing asset pricing, incorporating some certain money features on top of it. And of course, there can be a bubble feature in this as well. And any asset, you can have a bubble associated with that if certain conditions are met. Okay? So you have a fundamental value, which would be without this lambda. So if you take this out, then this lambda gives you a liquidity value. And then there's a bubble component to it. And what the bank typically does when you do money creation, what you do is you issue some of these bubbly assets, and it doesn't cost you anything. That we know from Friedman's famous presidential address to the AEA. There's no social resource cost to issue some bubbly liquidity. So if you can issue a bubble, that's fantastic. Or more generally, if you issue money as a bank, what you do is you hold some assets which have a higher payoff, but they don't relax your liquidity constraints. So an asset can be, I should have said that, an asset can be very valuable if it has a high payoff, Z, or it might relax the liquidity constraint a lot. Okay, so it is a cash advance constraint, so having an asset which you can use to pay with, it relaxes your cash advance constraint. So lambda is high, so this capital lambda is much larger than 1. So an asset has a fundamental value from the cash flows, and it has the service flow, this liquidity flow, because it relaxes some liquidity constraint. And what you can do as a bank, you buy some assets which don't relax the liquidity constraints of the citizens a lot, so it gives a lot of payoffs, and you issue some assets which gives less payoffs, but it gives them a higher relaxation of liquidity value. And this way you can generate some profits for the banks. Okay, and that's what money creation essentially is. And the question then is, how much competition is in the banking sector such that, you know, this return of this highly liquid asset is still fairly high. So if there's a lot of competition, then the banks will compete this advantage away. If there's very little competition, the banks will not compete it away. Okay, and that's essentially what's going on. So now I have to think a little bit what to do. Essentially, I know I'm running out of time. I'll take 1 more minute, sorry. What the paper does is that it can we create a system with CBDC, central bank digital currency, such that we maintain the current system as we have it. So if now the central bank is become more active in money creation, it might be with more CBDC, the central bank create more rich and crowds out private money creation from the deposit taking of the private banks. Okay, and you might say, essentially saying what you're saying, under what conditions does a Modigliani-Miller type or Ricardo-Agreements type theorem hold that, you know, we want to create a system where nothing really changes. And nothing really changes if all the choice sets stay the same, so the equilibrium is the same as well. And let me just give you one example. So here's my economy. So there are the firms have loans to the banks make loans to the firms, and they issue deposits to the households. There's some equity of the banks, there's some equity of the firms held by the households. And then there's a government and central bank as a consolidated balance sheet. There is government bonds held by the central bank. So some of them held by the households, some by the central. There are some liabilities, some are here as well. So the central bank might hold some of these bonds, you can net them out. And then there's money. And now let's suppose, and the central bank might hold some private banks, bonds, or debt as well. And that's my cash, let's say, or some CBDC or whatever digital form of cash. Now the question is, can I introduce CBDC such that nothing happens? So what does it mean? It means that the central bank is issuing now more cash or digital cash. So that's for the household, and crowds out deposit taking. So now suddenly it makes it much harder for the banks to issue deposits. But if the banks can actually now issue debt to the central bank, and the central bank is passing it through, then it can maintain equivalence. Okay. So in other words, as the central bank issues more digital currency, it gets more funds from the households, And the deposits which were before that, some of these deposits which went to the banks are now gone because it's now passed on the central bank. But if the central bank is just passing it through at the same interest rate the deposits were funded beforehand, then nothing will change. Okay. So the key insight is essentially, if the central bank is introducing CBDC and this additional revenue it raises is passed on to the banks at the deposit rate of the banks, then nothing will change. Okay. So you can design your CBDC in such a way that the real economy is not affected. So let me sum up. So what we say in this paper, so I was rushing at the end, sorry for that. Digital platforms and ecosystems, smartphones and tokens, these are the big innovations, and there's an unbundling going on. The three roles of money can be unbundled. We will have a lot of currencies, and each currency doing some different things. Might be a good store of value, might be a good medium of exchange, might be a unit of account. And it is not bundled as we experienced in the past, that all of the three roles of money are so closely tied together. And then we have a rebundling going on, and the rebundling is much more about combining it with other platform features. Okay. And then the regulation is, do we want so much rebundling with particular platforms, or want to enforce as regulators interoperability? So the interoperability is the big issue, and the convertibility are the big issues. So these are the big regulatory issues. And we want to limit product differentiation. So to avoid limited some monopoly power, limited competition within each platform. But more generally, we have an inversion of the I/O of the financial activity because of the data combination. So banks might become less relevant, big tech becomes more relevant. This depends very much on the regulatory framework. And that's also why the banks are lobbying so much on the regulatory side to get protected from that side. And then I was touching upon the digital dollarization. So having an impact on other countries on the digital space. So it's dollarization just on a digital space. And you have these new currency areas, which on the digital currency area. And the question is for monetary sovereignty, if you manage the macroeconomy, do you need some handle on that? And CBDC might be a way for the central banks to maintain its monetary sovereignty and also its role of lender of last resort. So the question is, who will be the lender of last resort? Is if everything is done in Libra, who will suddenly Facebook bail out banks who issue some Libra deposits? And or if everything moves away from the unit of account of this official currency, all the powers go away as well. And that's what worries a lot the regulatory community.
Markus, thank you for a very interesting presentation. We will take 15 more minutes for Q&A. There are 3 questions in the Q&A that you may want to start with. I think from that point forward, I'd ask people to raise your hand and I will unmute you. But why don't you start with these 3 that are already in the queue?
So let me read it again. Do you see any possibility to hinge private money to the real production through tokens? Our current monetary system seems to disconnect money supply growth from real production in the US and also globally. Yeah, so I would say that if you have digital money in many competing currencies, it's probably the danger is even higher that it will be disconnected from the real production because you have many suppliers of various forms of tokens competing with each other. So I think the current institutional arrangement provides a better framework for that, but I don't see how you can stick with the current framework. I think we will go away from that. Then Rod, so Young, you asked this question. It's a good question. I have to think a little bit more. I don't think I gave a fully satisfactory answer because it's a tough question. Central banks can introduce CBDC, but based on everything you said, in particular, the idea that there will be a rebundling that leverage new digital ecosystems with people use it. For example, when PBOC introduces its new DCEP, will people voluntarily use it? Yeah, so that's a very valid point. So it could be that the central banks just introduce some digital currency, but it's not nicely connected with the platforms. And I doubt essentially that central banks will be able to connect the best convenience features with some apps and so forth, like the private sector does. The only thing what central bank actually can do is that they are, and that's what China did already, that they ask a narrow money principle, essentially asking the platforms to back one for one it was the central bank digital currency. So at the end of the day, it's not the case that people will really use some digital currency directly. They will still use the Alipay, but behind it, there's always some central bank digital currency. And they ultimately can run into it. So in a sense that if there's any troubles with Ant Financial or anything and people get worried about the value of this, they might be able to take their funds out and run into the central bank digital currency. And to the extent that they're 100% backed as a narrow bank, the central bank should be willing to just not bail out, or just convert this into central bank that can give fund and financial, and there will be no run in the first place. But you can see already how the power shifts. Now then, that the private companies at the mercy of the PBC or PBOC, and the power is shifting between the private players and the official players. So Will Kong asked, you talked about how technology enabled rebundling and unbundling. Some argue that pressure from the private sector and other digital currency areas, coupled with availability of technology, smart contracting, linked list structured database, and so forth, may alter how central banks and CBDC commit to inflation or monetary policies. But at the same time, more ex-ante commitment to certain protocols reduce flexibility. What is your view on this issue? Yeah, that's, again, it's a deep point that if you have a lot of commitment, so central bank only works through commitment, in a sense that, if you do something just right now without any credibility, you have almost no power from central bank. I think Ben Bernanke famously said, central bank is all about communication and communicating what you will do in the future and credibly communicating, committing to it. But of course, if you commit everything away, you cannot do anything anymore. So there is some way to say, okay, I communicated, I will do this, but if the extraordinary circumstance, I'm able to re-optimize and do something else. And that's, I think, not changing with this technology. I don't think there's a fundamental shift compared to what the situation is at the moment. So if you move to a world with CBDC, it's the same as we have now. I think the bigger threat is if you lose the ability to influence the real economy because the power to set monetary policy is essentially going to some private players. And it might be an international corporation. And I'm not saying that the US will lose its monetary policy sovereignty. I'm talking mostly here about smaller countries who might be deeply affected by some big tech players who then, don't have any monetary policy to control their own economy. So I don't think it will affect, China, the Euro area, or the US or Japan in this regard. I think it will be more the smaller countries which have to watch out for that. And that's more of a concern for them. So it's smaller countries and also countries which are very open with respect to social media from other countries. So they don't have their own social media. They're all very much driven by the big tech companies going on. Okay, so let's move to the other mode.
Jergo, I am going to call on you. You may unmute yourself.
Hello, can you hear me?
Yes.
Hi, Markus.
Hi,
thanks for. I know quite a bit about the China's plan. This is CBD. They call it DCEP, just a name. But my understanding is that they would like to me, it's pretty good plan, which is that make it electronic, and you can call the force or push the private guys to embed it into all these payment system. And hopefully that way that the private guys still get all the data and they could do whatever they want to do. But it's also making sure that in the end, there's a much less fraud, all these things. And then at the same time that put in a way that make the digital part of the benefit, gets to the maximum potential. And it's also help with the country, right? Country when they internationalize their currency, then there's no issue of Ali currency or whatever. I just want to know that what's bad about it. In a way that it's optimal design, what can you see that the drawback of this way of thinking it? It's just one particular design of the digital currency for central banks.
No, there are many details one has to watch out for. So I have to study the Chinese situation more carefully in order to give you a satisfactory answer. But the question is, of course, privacy considerations are one big issue. And then there's the question, should the private companies observe all my payments? Or should a private company plus the government observe all my payments? So that's one thing, and that's not obvious how to answer it. And how should perhaps it's ideal if part is seen by the private company and part is seen by the government. And I can also see that that's I think the internationalization of the currency. I can see that's a very valuable instrument to push the renminbi to be a more internationally accepted currency. And rather than traditionally what the US is a very good reserve currency, it's internationally the key currency. But if you all move electronically and if all many citizens across the Southeast China use Alipay anyway, it's a very easy way for China to expand its influence in currency in the other countries. And that's, if this could be one, and that the government might say, oh, why should Alipay control that? We would at the back end, at least, it should be the official sector controlling it. Okay? But it might also mean that other countries might be much more reluctant. They might be open to a big tech company to control it from another country. They might not be open if another country wants to control my currency. So that's my backfiring on that dimension.
Yeah, last part is very real. Thanks for the last point. Yeah, thank you.
Okay, I think we are about out of time. Markus, if you would kindly stop the screen share, I would like to briefly promote. So I'm going to just share with the audience our next event. We meet on the first Thursday of every month, and so this would be September 3rd at the same time, 11 a.m. Rod Garrett from University of California at Santa Barbara will be the speaker, and we hope to see many of you then. So Markus, thank you very much for a fascinating presentation, and thank you to all the guests who joined today. So have a good afternoon, everybody. Thanks again for all of you guys and for attending and for especially inviting me. Thanks, David. Okay, bye-bye. Bye-bye.